Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hey audience, welcome to Achieve Wealth podcast, where we focus on commercial real estate asset class and we focus on value-add real estate investing. Today, I have Kenny Wolfe, who owns more than 2,000 units. Kenny is a well-known sponsor in the Dallas market, and he owns deals across the nation. Hey Kenny, welcome to the show.
Hey James, thanks for having me.
So why not you explain to the audience about more background about yourself, because I think I may have missed out a lot of things.
Yeah, that's all right. So we started investing in multifamily real estate over 8 years ago. We started out here in Dallas, Fort Worth, Texas, but quickly branched out. So we've owned multifamily properties in 5 different states. Texas, Oklahoma, Colorado, Ohio, and Louisiana. So those are the 5 states we've been in. We're out of Colorado at the moment. We sold that property, and we sold the property in Louisiana and are back about buying a property on Tuesday in Louisiana. So we'll be back there in that state as well. So, and then within those states in Ohio and Texas, we're in multiple markets in those 2 different states as well.
Awesome. So you asset manage and operate the entire portfolio, right? Is that how you do it?
We do. We have some deals where we're passive as well, and then there are deals where we've co-sponsored in the past. And so, our total unit count that we've been involved with is almost 3,600 units now. I think we're down to about 2,000 that we actually asset manage. We've sold some off, but we're buying 400 units on Tuesday, so that'll make a lot of that up. So.
Oh yeah, that's a big number.
It fluctuates. So.
So why did you? You are in one of the hottest market in the country, right? Dallas. Why did you go to other markets?
It got too hot for me. I couldn't. I started out buying deals back in 2010, right? And so I've seen the run up in the cap rate compression firsthand here in Dallas, and it's been very big and very real. I felt too hot for me. I thought prices were high 4 years ago in Dallas, Fort Worth, so I called it a little early. It forced us to, and I think in hindsight that was because I was wrong. I still think it was a good idea because it made it possible for us to grow quickly in those other markets and have bigger deal flow and get used to different markets too. I think if you're stuck on just one market, it can be problematic for you because if you sell something in that market at the peak, what are you going to buy if you just focus on that one market? So anyways, that was kind of our thought behind it. Diversify and kind of chase some good deals.
That's awesome. So at what year did you call Dallas was too high?
It's going to be, I think it was like 2014 or 2015. So I was really early.
That might be the right call. I don't know. After 2015, everything was IO deals, right? A lot of IO loans came into the market. So I don't know. My thinking is that has continued the multifamily boom, right? Because people can still justify the cash on cash.
Right. Well, yeah. You've got to, and it depends on what you're looking for too. Some of these investors that we were dealing with coming into Dallas Fort Worth were foreign investors, so they were okay with a lower return. And then also we had a lot of 1031 exchange money coming in from California and elsewhere, where they just wanted to, they were okay with lower returns because they were able to offset a lot of their tax burden from their property they sold somewhere else.
Got it. So what was your underwriting criteria when you say Dallas was too hot? When did that cross and what was that number?
Well, so we've always stuck with our original underwriting was to, when we underwrite a deal, we like to double the investor's money in 5 years or less. Mm-hmm. We like a double-digit average cash-on-cash return over 5 years. Okay. We've done deals where it's 9.5 when we projected that. So I mean, we've I guess gone down to 9.5 cash flow, but we still double their money in 5 years or less. So if we can't do that, then we don't offer on the deal. But I mean, I've seen some of these groups, these guru groups, they've changed from our our same underwriting criteria, doubling their money in 5 years or less, to maybe 75% or 80%. So they're changing their underwriting criteria, which, if you ask anybody who's been through the last cycle, that's what they did. They changed their underwriting criteria to make the deals work. So we've always stuck with that number, and that's why we were priced out of Dallas-Fort Worth, is because that you just couldn't find that very easily.
Okay.
So.
Yeah. So basically, you were priced out because you didn't change your underwriting criteria, right? And then
yeah. So we've stayed conservative on that too, but that's what drove us to other markets, and now we get on planes a lot, but that's okay.
So how did you choose? Okay, so now let's say today Dallas doesn't work, right? How did you choose your next market? What was the process that you went through?
So we went to the market we went into first after Dallas-Fort Worth was Colorado Springs, Colorado. So that market was interesting. We bought that deal at a 7.5 cap rate, and then a truly 7.5 cap rate. Market rents were low as well. There's a lot of deferred maintenance and rehab we could do as well. So we liked that market. It was close enough to Denver as well, which had a lot lower cap rates. So we felt like there was going to be some rent growth there. So that's where we went next, and then Oklahoma City, and then Columbus, Ohio. We kind of danced around. But typically what we look for in a city is if it's has typically low unemployment, historical low unemployment, population growth, jobs. Obviously, we want these tenants to be able to pay rent. So they have to have a job.
Absolutely.
Job growth. And then also to make sure it's landlord friendly. There's a lot of, I just read an article, I think it was yesterday in the Wall Street Journal, about how there's 12 states about to introduce, in their state legislatures, a rent control. And they're, for these states, and Oregon was the one they were picking on, but they're going to cap rent growth at 7%. As a state, and then the cities sounds like the cities can come in and add more constraints on that as well. So we like to pick landlord friendly states. So Oregon would not be one of those.
I used to live in Oregon, so
I'm sure it's beautiful. But man,
beautiful in summer. So other times it rains a lot too, but it's a nice place.
Right.
So let me understand the process. So you basically, Dallas doesn't work. Now you look at across the nation, you look for landlord friendly, and then you start from there. You look for population growth and jobs growth. Is that right?
Right. Yeah. Population growth, low unemployment, historical, long-term population growth, things like that. And then also we want it to be, we want to have a very, very diverse economy. So I always pick on this city, and eventually they're going to they're probably going to write me a nasty letter, but but we don't buy deals in Midland, Odessa, because that's all oil and gas, right?
I know someone who bought there.
Well, because to me, if you buy Midland, you're really
it's an oil and gas play, right?
Yeah, you're really in the oil business if you buy real estate in those cities. And same with Killeen. Kelleen's all military. There's really not a lot of other jobs. So to me, those markets we stay out of. We like the diverse economy.
Got it.
A good one would be, so we're in Columbus, Ohio. So that's the state capital. It's got a huge university there, obviously, Ohio State, the Ohio State University, I'm told. That's how you say it.
Oh, really? Ohio State?
Yeah, the Ohio State. And then you've got Nationwide Insurances there.
Okay.
Victoria's Secret, Abercrombie's there. So you've got a lot of very diverse economy. So that always helps through any kind of recession, because if you're not banked on just one economic driver, then it'll help you weather those storms.
So apart from Dallas, is your Columbus, Ohio is your second favorite? Can I say that?
Oh man, I don't know if I got a favorite. All my
second favorite
will give me grief about that. It depends on the market. Right now we're buying a lot in El Paso. So we have El Paso now. I like that one personally because there's really not a lot of third-party management companies there in that town, even though it's a town of about 1 million people, because 80% of the units are owned by 6 families. And so that's really helped keep the prices low at the moment. But we're starting to see them creep up as the as folks come in. So right now you basically have to be an owner operator to buy in El Paso. And since we own Allied Property Management Company, or a big chunk of it, it's easier for me to get to El Paso than someone who doesn't own that. So right now we've got an edge. I think eventually the next year or two, that's going to break wide open, and we're going to see folks prices go up, and put folks that don't own their own management company be able to buy in there.
Got it. Yeah, El Paso, it's, I don't know, when I was looking at Marcus and Millichap report for 2019, I was just looking at certain trends of supply and demand and construction, and I was looking at a cap rate. And very, very few cities came like to be like one of the best one. And somehow, for some reason, El Paso was there. I was thinking, what's happening in El Paso? So, yeah, I mean, I know not many people buys there. You are buying there for the reason that you said just now, right? But indicator wise, it does look very favorable. I believe there was not much of construction coming in, and the cap rate is still healthy, something along that line. I need to go.
Yeah, there's only like 120 units being built in El Paso for all of 2019. And it's a city of 1 million people. So that's always good, right?
And it's one of the largest city, right, in Texas and the nation too, right?
Yeah, it's number 19 on population size. So it's pretty big.
Correct.
Also, it's got a lot of its economy is driven from the import-export business. It's the biggest import-export route for the U.S. and Mexico. A lot of it, that's highly diverse, obviously, if you're dealing with import export. And then you've got some military too. You got Fort Bliss out there. Texas Tech has a very large medical facility. I don't know. There's just a whole bunch of drivers there. You've got UTEP, which is a college of about 20,000 kids as well. It's very diverse on that way. The growth is slow and steady. It's nothing great, but it's always growing. So that's good as well.
So is there any deal that you comparatively to performance in Texas made much better, in terms of performance outside of Texas?
Yeah, I mean, let's see. Our deals in Columbus, Ohio, those have been home runs. We showed up there about 4 years ago as the crazy Texan buying in Columbus, Ohio. That was us. And so we got out there. Bought a 120 unit deal. I underwrote that we could do an upgrade package and get about $75 a month. We ended up getting about 150, and that was a B- deal there. And at that time, so when we got the reason why I got to turn on to Columbus, Ohio is Berkadia has this annual report, and it goes over the biggest markets in the U.S. And talks about their, like you said, the prior year, the current, and what the current year outlook is. And at that point, it was the only major market that hadn't crossed over 2007 per door prices yet. So when I read that, I hopped on a plane and I said, I'm going to figure it out. So because that was just unheard of. So
can you repeat that? It didn't cross over the 2017 or 2007 prices?
Yeah. So at the peak of the last cycle, even just 4 years ago, they hadn't quite gotten back to that 2007 peak per door price.
Okay. Got it. Is single family pricing, or is it multifamily as well?
I was focused on multifamily. I'm not sure.
Got it.
Multifamily, for sure. So when I read that, I was just amazed, and because it's a solid city, and it's grown for kind of steady about 2% a year, 1.5 to 2% a year since 1850 something. I did my research on it, but so anyway, so that's been a good market, but we were the first ones to kind of do an upgrade package. No one was really doing the faux wood, the backsplash, all those kind of things like we've done here in Dallas for years. So we were kind of the pioneer in that. I don't know about the sole pioneer, but we were one of the first ones to try it out. So that's been really good. So we ended up buying 2 assets there, and then everybody heard about Columbus, and now I can't buy anything because that's too expensive.
Tell people, Kenny.
I know. People keep catching on. I keep talking too much on these podcasts.
So coming back to Columbus, Ohio. So in terms of underwriting the deal in Columbus, Ohio, right? What do you see significantly different from underwriting a deal in Dallas or in Texas in general?
Well, so what's nice about these other markets too is that you don't have 20 people bidding on the same property,
Got it.
And that always drives up your price and also your terms too. So like in all the deals we've done over 8.5 years, I've never had hard money from day one. Never.
None of it, all of it?
Yeah, never hard money from day one. And so that's, I like that model. I don't like to have money at risk from day one.
Yeah, it's so much of pressure, right? To have day one hard money, and The broker controls you, the lender controls you. Everybody controls you because they know you can't get out from the deal.
Right, you've got to close it, right? And so we've never had to do that. But part of that's because we've gone to markets where there isn't much competition, right? And also now the past 4 deals we've closed 4 multifamily deals in the past 4 months. So it's been crazier at the office, but all 4 were off market deals. So one was a straight transaction between myself and a buyer, no broker involved. And then the other 3 were, what we call off market. So there's like 4 or 5 of us that have seen it, but they were not taken to the open market. So it's only a few of us bidding.
It's a selective off market, I would say. Okay.
Right. So we've kind of focused on those the past, I'd say, year or so, trying to find those deals. And we've been pretty good, successful at that. We've actually bought, it'll be 6 that the last 6 we bought have been that way, off market or off market.
Yeah. So in terms of buying directly from the seller, is it someone you already know, or you did some marketing to reach them, or how's that?
Yeah, well, it's pretty simple. I mean, it's this business we're in is not rocket science. So I did a little bit of homework. I bought a deal from him in the past, and I took him out to lunch, knowing that his kids aren't really into B and C apartments that he owns a lot of, and he's kind of getting older. And so anyway, he's his kids are into development, and so I took him out to lunch after we bought the first deal and said, hey, if you got any other things for sale, let me know. At lunch he said no, but then 2 weeks later he calls me up and says, hey, do you want to buy this deal? So it was a fair deal. I mean, we worked well together on the first one, so we kind of understood each other. And so buy lunches for folks that have units. I mean, that's what I tell folks.
Yeah, but I'm sure you would have created that reputation of a good closer too, right? On the
and that helps. Yeah. I mean, that helps. We wouldn't have gotten any of these off market deals if this was our first deal.
Correct. If it was first deal, and if you're becoming very hard to work with, right? Then they would not want to sell to you. They'd rather just go to a broker and just get them to deal with all the pain of dealing with the buyer, right? But if they know that you're a good closer, they would definitely want to sell to you.
Right. Well, and even then, when you go through a broker, I mean, you still want to. In all these deals, it's a very small world in multifamily. So if you are trying to nitpick and give the seller a lot of grief about some small things and try to retrade about exterior paint, which you should have already put in your numbers, or things like that. If you try to do that stuff, you quickly get a reputation because it's a much smaller world in multifamily. And you're not going to get very many deals if you do that kind of stuff.
Got it. So coming back to Columbus, Ohio, I just want to close out on how to underwrite Columbus, Ohio, right? So what about property taxes and insurance? Is it comparable to Texas?
So insurance is cheaper. And what's been great about having a portfolio that's across, kind of not nationwide, but across multiple states is that because we have such a large unit count, or large enough anyways, we're able to get a master insurance policy. But our Ohio properties actually help our properties in Oklahoma and Texas with lower insurance.
Right, because diversified risk, right?
Right, yeah. So the insurance companies love that when we own across different states. So that's a big plus. Property taxes in Ohio are just about as bad as Texas. Not quite as bad. It's harder to fight up there though. So they they know what you paid for it, and they pretty much stick to that. So there's really no property tax protest business in Ohio like there is in Texas.
Okay, and you must love the cold weather there, right?
Well, I try not to go in January. I avoid January. I did that the first year we bought that deal. I flew up in January and it was 8 degrees when I got off the plane. I swore to myself, never again.
Never again. I'm going to hire someone to go for you.
Yeah. Now in July, I like it. July is great. July is awesome. So get away from the heat in Texas.
Okay, cool. So let's go into a value add strategy, right? What do you think is the most valuable value add?
I like the deals where, we've done everything from, we bought a D class deal and brought it up to probably a C plus, B minus. We've done those big heavy value adds, but the ones I like are the ones where the seller hasn't, they've done a lot of the work for us, but they haven't capitalized on the rents. So an example is our first deal in El Paso. The seller put in 120 of the 188 units. He put in the vinyl plank, wood, and didn't charge any money for it. He didn't charge a premium for it. So that's a lot of saving. That's like $800 to maybe $1,000.
Flooring is expensive.
Yeah. So, I mean, he already put that in. In our due diligence, 8 out of 10 of them were in good shape, good enough to keep. Didn't have to do any repairs. So that was awesome. So on that property, the ones, we're calling those classic units. So if we just put in either clean the carpet if it's in good shape or put new carpet, we're getting an extra $60 a month on rent. And then on the premium units, so we're going in doing a backsplash, doing new cabinet fronts, stainless steel package. Those are getting $100 on top of the $60. So we're getting a $160 rent increase over his embedded rents. And it's fairly inexpensive for us to do it because he's already paid for the flooring for the most part for us. So those are the deals I love because it's easier, it's bigger return on investment than some of our others where we've done this huge value add. When you've taken it from a D to a C plus or a B minus, that's those are fun and a lot of work.
It's a lot of work,
but it also takes a lot of capital too, right?
Correct. So, but let's say you're doing a full value add on a deep value add, right? On exterior and interior,
right?
Let's say, and you have a very limited budget, where would you spend the most money?
Well, so you have to do the exterior first. I mean, where I've seen a lot of folks go wrong and where we've actually found some good deals is where they put all the money on the interior of the units, but didn't put much money on the exterior. You got to be able to get people to the property.
Okay.
If you don't do that, how are they going to know that you have good interior units, right? They're not going to believe you, no matter what kind of online marketing you could do. Yeah. So you've got to have that fixed up first. And then I would do, slowly turn the units if you had to do that way. We always raise our money up front for all the rehab, but for those that don't, which I don't recommend, but if you do that, then exterior first and then start doing the interiors upgrades as you can. Otherwise, you're not going to attract the right residents to your property.
Yeah, that's absolutely right. So how would you bump up the rent? Let's say today you close on the deal, right? So you have 30 days, 60 days, and 6 months, right? So how would you stage your strategy to turn around that property?
It depends on the asset. So a deal we're buying on Tuesday in Shreveport, it's 70% occupied. So it's 400 units as well. So that it's for those who can do quick math, that's 120 vacant units. So for that deal is different than the deal we bought last Thursday in El Paso, which was 95% occupied, right? 94% occupied. They're different strategies. So on the one in Shreveport that's less occupied, we're going to have 3 crews that go in and do, they're going to be able to do 30, each of them should be able to do 30 units in about 30, 45 days. So we should be able to knock out all 120 unit upgrades in 3 to 4 months. So that strategy that's how we do that one. We also have already picked out the new name for the one in Shreveport. We're going to get the new logo going here pretty soon. So we'll get going on the exterior as well, but the interior to get the higher rents for upgrades. On that one, we can just kind of blitz it and do a whole bunch at once. The one in El Paso, that's going to be a little bit slower because it's more occupied. You can't upgrade units while they're in there. So. Got
it. Hey, audience, if you guys want to ask questions on the interior topics, you can definitely ask questions. So I can ask Kenny on while I talk to him. So do you change name every time you buy a deal?
I'd say probably 90% of the time. So we bought a deal, an A-class deal. It was built in 2018 in Greenville, Texas. We kept that same name because it was brand new and it had really good reputation. But most of the time, we do a big rebrand with new logo, new signage, at least some kind of paint color. If the paint's in good condition, we pick a few walls or trim to change the paint color to give it a new pop. But most of the time we do a rebranding, especially if you've got bad reviews online. You do the rebrand, and then all of a sudden, you've got a new asset. So
yeah, correct. Why do you buy an A-class deal? I mean, does it make money?
It does, and I'll tell you how. I mean, so we at that deal, we were the only non-institutional person at the table. Everybody else was a bigger institutional buyer. We ended up getting the deal, but mostly out of persistence. So I think we just annoyed the seller.
To buy the broker lunch again?
No, it was the seller. I just kept annoying him, I guess.
Oh. So you had a relationship with
that one did go through a broker. That one is really interesting. So that one, it was a value add play, but we didn't really know it at the time. We thought it may work, but we didn't underwrite to that. So our underwriting, we were able to assume the builder's TDHCA loan, which we stacked that on top of our new Fannie Mae loan. And so our leverage was 84.4%. And the blended interest rate was 3.85%.
What was the loan that you mentioned in the beginning? TDAC?
Yeah, I had to learn it too when they first told me about it. So TDHCA. So it's a loan. It's a loan of the Texas Department of Housing offers up.
Is it like tax credit loan?
Well, part of it. It's partial. So 20% of those units are capped on rent.
Okay.
But they're capped at the median, the 50% of the area median income. And so the area median income in that area is about $70,000 a year.
Okay.
So to me, that's not really capped. I mean, our capped one bedrooms go for like $900.
Oh, that's no cap.
But the cool thing about that loan is that they provide this loan at 0% interest. And so it's principal payments every month, but it's 0% interest. So your equity is building up really fast in the property. And then we were able to assume that and stack that on top of our new Fannie Mae loan. So that's how we got the higher leverage, and that's how we're making money on the deal. It made it so where we're getting the returns of a B or C class deal, but on a brand new building.
Okay, so the value add is on the financing.
Partly, and then after the fact, so the builder, it's beautiful. I mean, it's got really nice cabinets, granite countertops, really nice faux wood, the vinyl plank faux wood, a little bit higher end than what we usually put in our stuff. But he did black appliances and he did no backsplash. And so in 4 of the units so far, we've done just to test it out, we did a stainless steel package. Appliances and then added a backsplash, and we're getting an extra $100 a month for that. So the cool thing about that is that it only cost us about $1,800 to do that upgrade, maybe less, maybe $1,750, $1,800. But we're getting a $100 rent bump. So the ROI off of the amount invested into those units is so much higher than what we could get on a B and C property. Our payback is almost a year, whereas if we had to get that same rent bump on a B or C, we may spend $3,000 to $4,000 a unit on there.
But you said you didn't realize that it was a value add when you initially looked at it, right? So, but why
did you look at it? We kind of going in. We thought about, okay, well, we're going to try out 4 of them and see what happens, but we're not going to put that in our numbers. We're not going to model that out.
Oh, got it.
But now that we've done 4, I've approved another 5. So we'll keep doing them until they spend $100.
So initially your strategy was try to use this combination of loans to get a good return, I would say, right?
Right. And then also the deal also came with 13 acres of raw land.
Oh, got it.
So that's kind of the kicker down the road. We'll be able to double our unit count in probably 3 to 5 years, whenever the market's ready for that extra 170, 180 units.
Awesome. So how do you sniff test your deals? Because you are looking at nationwide, right? That's going to be like hundreds of deals coming to your desk. So can you describe a process? What do you do when you get a deal, and how do you narrow it down?
Yeah. So the first thing I do is I check the median income in that in a very small radius around the property, and half mile is too big. I'm talking like a quarter mile. And we use a website called city-data.com. We've been using that for years, but I looked that up because I'm pretty choosy. But the deals that we've bought where the median income is equal or just about equal to the price per door that we're paying, those have been home run deals. And again, it's not rocket science. The reason why that ratio works is because if I'm able to buy it at that ratio, then that means their operations are not good, because they should really be getting a higher NOI. They should either be able to charge a lot more rent than what they're charging, or they're not running the expenses efficiently, or both. But that's kind of how I sniff test it these days. Because every deal we bought like that has just been a home run.
So do you do that for all the deals, and do you do it personally, or you have someone sniff testing for you?
So yes and no. So we have interns every once in a while throughout the year, and so whenever they come, I have them do a lot more of that. So our scope's a little bit bigger. So far with these 4 deals that we got, they were brought to us off market, and so that's kept us busy enough where I didn't really have to look at stuff on market at all. So that's mostly what we've been looking at. So when we get those off market deals, I underwrite it. That's one piece of the business I have not been able to let go yet.
Yeah,
and that's a personal
fun
problem.
to underwrite, right?
Yeah. So that's, I mean, that's something I need to work on eventually if we're going to keep growing like we are. But right now it's something that I do. And then, like I said, I get interns in here in the office pretty frequently, and train them up and they can do some of that easy kind of simple snip test and stuff.
Got it. Are you ever looking at deals at Dallas right now, or you're giving up on Dallas?
No, I mean, I toured an off-market deal. It was an A class, kind of similar situation with the last one we bought, but it was off I-35 near Louisville. But it was a deal where 20% of the units were capped on rent, but the median income is like $120,000 right there. So again, I don't know why the state of Texas is giving these loans, but whatever, we'll take them, I guess. The numbers didn't quite work out on that one. But it may come back to us. They were having troubles with the other buyer. I'm actually getting the contract, solidified on it. So we're, it's kind of in our back pocket to look at that one again. But if it comes back, but for now we're kind of holding off on that. But we look here, but it's got to have a heck of a story of why is it priced way below market? Because we're not paying. We're not going to pay the $95K a door for some of this, C and B stuff.
Correct. Especially if you have seen it at 20 and 30 a door.
Yeah, I mean and that's partly my problem too. I've got baggage, right? I've been doing
exactly
for years, and I know what we paid way back when, and so because we bought the first syndication deal I did was a B class in Wiley, and we paid $45 a door for it. Which now is just laughable. No one, everybody would buy that in a heartbeat now, but anyway, so that's partly my issues. I've seen it when it was $45 a door for a B class,
correct.
95 to 100 plus. So.
Yeah, it's hard, I know, because everything else seems to be very expensive because we have seen the lower prices per door.
Right.
Can you give like 3 things that it's part of your secret sauce for your success?
Okay. Yeah, I was just talking to a guy yesterday, a guy just starting out, trying to figure out how to get started. And I was telling him that he lives in Massachusetts, so that's a pretty hot market too for multifamily. But I was telling him, look in your own backyard. So if you live in Dallas, Fort Worth, look in Dallas, Fort Worth, but pick 2 or 3 other markets that you're willing to travel to, and look there too, because you're going to get better deal flow. So that's really helped us expand immensely. It got us into a lot of other markets, but also it got us into starting to vertically integrate as well because we branched out so much. So I think if you're able to pick 2 or 3 other markets than what you live in and be able to travel there, somewhat frequently, then I think that's a good thing. So I guess number 1 would be look at multiple markets. For the better deal flow and better quality deal flow. Next would be I was very glad we stuck to our guns on our first syndication deal. We wanted 60 units or higher. It was easier for us. It's so much easier to buy a 60 unit plus or 80 unit or 100 unit plus deal than a 20 or 30 unit deal. So that was something I think starting out was a big deal, was how, being able to be patient enough to find that, 70, 80 unit deal, just because it's so much easier. Our portfolio would not have grown near as fast had we chosen that 32 unit or 20 unit deal to start out on. So that would be a big deal because then you can afford the third party management company where they handle the day-to-day operations. We've been in almost 3,600 units involved, and I don't know how to evict anybody. I don't know how to change out a toilet, and I don't want to. I don't want to know that. That's somebody else's job. My job is to grow the portfolio. So if you focus on those smaller units, you can't grow your portfolio as much because you're dragged into the day-to-day operations on that. And then also, I think the third biggest deal is making sure you have a quality team around you. And so I kind of use that as a broad scope. So yes, we've got folks here in the office that help, asset manage. We've got behind the scenes people that work with paperwork and all that kind of stuff with our investors. But also it's a matter of, finding the right lenders, finding the right management companies. We're doing all that legwork to meet the right folks. And that's going to set your business apart from everybody else.
Got it. Hey, one of the things that I want to ask you before I forget is because you have trying to grow portfolio by buying businesses as well. Can you explain what are the businesses you're buying and why you're doing it and what's your end goal?
Yeah, sure. So we're so back last March, so a little over a year ago, we bought into Allied Property Management. So I own about 49% of that company. And so they were an existing management company. It worked out because I would bring all my units over to them. So we could hire better people. And so that's really taken off. But now what we want to do is buy a few other management companies and bring them under one umbrella. And then we're also looking at a few other ancillary business to buy. So the way I look at it right now, if you're just an investor, you make money off that one line item on the income statement, the NOI, right? That's where you make your money. Mm-hmm. Well, there's 20 other line items on the expense side where folks are making money on your deals, right? So you might as well start bringing that in house, and then making money on that as well. So we're looking at landscape companies to buy. So we'd buy existing ones, someone who could run it already. And flooring, import business. Go ahead and buy an existing one because you're buying them for 3 to 4 times cash flow. So it's a really good investment. Your returns are pretty solid. But then being able to bring that in house and say, oh yeah, all of a sudden there's 10,000 units where we can plug in some potential buyers for these services as well. So start plugging in those, and then the goal is to package them up under one holding company, and then either sell it off or go public. There's a few other exit strategies we're talking about, but that way we could really expand the value of that holding company that has a whole bunch of ancillary things. We also have a construction arm as well already. So,
but don't you think it's going to distract your focus when you go to different?
I get that question a lot. So because we're only buying businesses that already have folks that run them. So like an example, there's a property management company in Ohio that we were looking at. The owner's ready to sell, but he's also the CEO and president. So he's in the day-to-day operations. So my question to him was, well, if I buy you out, who's going to do the job? I'm not doing it. I'm in Dallas, I can't do that. So I said, I'm not interested. I'm not interested yet. I mean, you've got to hire someone to replace you on the day-to-day who's going to stick around after the sale. And then I'm interested. But until then, I'm not, I'm not really interested in folks on businesses that where first question is who's going to run it after we buy it? And the answer is not me. So it's got to come with someone who already runs the operations.
So you look for some self-sustaining business and you just want to buy it as a business and let someone else manage it, I guess.
Exactly. So, I mean, it's kind of like the Berkshire Hathaway model, right? So Warren Buffett doesn't buy businesses where he has to manage it. He buys them already existing where there's management in place. And so we're taking that same model and applying it to the management business here for multifamily.
Got it. And when you say 3 to 4 times cash flow, that means basically the cash flow for the year, let's say it's 100,000, you're basically buying it for 300 or 400,000. So your recovery is very quick, I guess.
Exactly. So for those multifamily investors, that's like a 33% cap rate.
Yeah, exactly.
So it's not a 25 to 33% cap rate. So it's a heck of an investment, but also too, what's cool is that because, I think we'll be about 8 to 10,000 units under third-party management by the end of the year with our management companies. But we'll buy these existing businesses and then, and then be able to say, hey, here are these 10,000 units that you can also do business for. So.
Oh, got it. Very interesting. That's a very interesting model. So let's go back to a bit more personal side. So throughout your real estate career, right? is there a time where you were really proud of yourself for doing something in the business or in?
I guess the biggest one I guess would be, or we've had a few, but I guess the biggest one would be after we closed that first deal. So we went from 0 units to 76.
Okay.
We syndicated 76 units for our first deal. I was never in single family either. That's kind of,
so you went direct to multifamily. That's interesting.
Yeah, I went from oil and gas to multifamily. And so 0 units to 76. So once we closed that first deal, that was a very proud moment. That was stressful. The first one's always stressful, but it's we got it done. And the rest is history, I guess. But that's a proud moment. Another one happened just a few weeks ago. One of our investors called me up, and he was signing up for one of our latest offering at the time. But he was able to check the accredited box. We asked if you're sophisticated or accredited, and he said, this is the first time I can actually check the accredited box. And and I wasn't the only person he invested with, but he did invest with quite a few of our deals. So we got it. That was pretty cool to actually, he thanked us for being able to kind of move that needle to the accredited mark for him as a passive. And so that was pretty cool to hear. I got goosebumps when he told me that. So
yeah, it's interesting that a lot of passive investors become accredited or become millionaires because of a lot of sponsors' hard work, right? So that's very fulfilling as well.
Yeah, that's cool.
Right. So that's good. That's good. And when you look at your daily habits and your daily, whatever you do on the day-to-day operation, what do you think makes you very successful?
So, it's a little, I went to Tony Robbins, so it's I'll put that disclaimer out there, but so I picked this up from him, but, I start my mornings every morning about 4:30, 5 o'clock, but just do it like a kind of a gratitude mindful exercise. So I just kind of pick 3 things that I'm grateful for, kind of go do that. And then, and then imagine any kind of hurdles that we've got at the business or what's going, if there's some stressors in my life, kind of focus on those and those getting smaller. And then, that really helps kind of clear focus for the day, for me. And then, and then it's the rest of the day is, getting to the office and working hard and making sure all the teams are moving in the right direction. And, that's about it, man. There's no secret sauce to it. A lot of hard work.
Not the secret sauce. I think is waking up early and visualizing and being grateful. Is something that a lot of successful people has been practicing, right? Which is
right. Yeah, exactly.
Keeps your mind very focused.
Right. Yeah.
So, can you give a 3 to 5 advice for newbies who want to start in this business?
Yeah, I kind of gave a few of them away already, but but so I would say. Go big or go home. So start with a 70 unit or higher, a 30 unit deal or 20 unit deal. I kind of equate it to buying a boat. There's 2 good days when you buy it and when you sell it. In between is going to be a lot of hard work and it's going to slow down your growth, your portfolio growth. So that's I guess the biggest deal there. Then it's to build that team. You've got to find the right management company that's going to take care of your asset, the right lender to work with. You have to find your investors as well. So, and it's a lot of networking, I guess, would be the second one is to network. And that's going to cover all 3 of those investors. And then the team that you're going to need to actually buy the deal from the lending and the management company as well. So you're going to need that. And then focus on more than just one market would be my next suggestion. You're going to be able to grow a lot faster and start a lot faster if you're willing to go to places that folks aren't interested in buying yet. So like we just bought a deal in Cleveland, Ohio. So, which is, a lot of folks they hear Cleveland and they think the lake still catches on fire. So, it hasn't happened since 1978. So, but anyway, so there's a lot of folks that are turned off by markets like that. But me personally, I think they're missing out on the true facts of what's going on in Cleveland. But there's other markets like that too that are not being attacked yet by some investors, and so it might be good. There's always deals. You just got to be able to find them and be willing to hop on a plane. Kind of one of my big aha moments was I was driving to. We hadn't bought a deal outside of DFW yet, but I drove to Oklahoma City just to check it out because it was the closest next major market for us it was north of Dallas. So hopped in the car. It was a 3-hour drive. And on the way back, I was like, if I'm willing to drive 3 hours, one way, and then come back that same day 3 hours, what does it look like if I hop on a plane? What does that open it up to? So that really opened it up, so that's because that flight to Oklahoma City is like 35 minutes now. So we fly there, but we do day trips to El Paso. We do day trips to Columbus, Ohio. So that really opens up where you can buy. So, I highly recommend being able to, think bigger than your own backyard. Especially if you're buying a bigger deal and you have third-party management that's local or has a couple thousand units there in that market. It makes it a lot easier to buy it from afar when you're buying a bigger deal.
Got it. Hey, coming back to asset management, right? So what asset management tools do you use? Because you have a lot of deals scattered across all over nation.
The biggest secret is a weekly phone call with your regional manager.
Okay. That is something important.
Yeah, that's pretty important. So we have a really good asset manager now on staff. So he flies to Columbus in January when I can't or don't want to. But
he want to go.
He travels a lot more than I do. I go when I can, but he definitely does a great job. That's really helped us out on the asset management side. And eventually you have to do that. It's part of your growth. You can't grow without an asset management or an asset manager to help you out once you get to a certain unit count or how many properties you have in different states as well, right? There's only one of you. So.
Correct. So coming back to the phone calls to the regional, right? I'm sure the asset manager or you making the calls. What are the questions usually you ask them?
It always starts off, what's occupancy? What's our pre-lease number? That's the obvious first question. And from there, you can really dig in because if they're and then traffic as well, what kind of traffic are they getting in? Is it a lot of traffic? Is it quality traffic? That's a big piece. I always ask, when's the next community event? When are we doing a bounce house or a pizza day or a taco Tuesday or, those kind of things. I think that sets us apart from our competition. And then talk to the regionals about what's going on at the property, how the managers are doing, where we need to improve, how our collection's going. Renewals are big. That's a big question for me. If our properties are less than the 50% renewal rate each month, I kind of question the work orders if they're really being done. Okay. Because if they're happy, the average in their business is 50% turnover. So if we can beat that, then I know we're giving pretty good service or good service at least to folks. So that's a big deal I look at as well.
Got it. Disposition of assets, right? How do you decide at what point you want to sell or refi or continue to hold the asset?
Really depends on the asset. So like our deal in Wiley, so it was our first syndication deal. We still own it. We have through a supplemental loan, we pulled all of through a supplemental loan and the cash flow, we were able to pull all the investors' initial equity out to them within 30 months. So we don't have any of our money in the deal. We've owned it 4 years since then, past that, and it just gets cash flow quarterly. And then about 2 years ago, we had a huge hailstorm. Of biblical proportion, it was huge. So we got 56 brand new windows on a property of 76 units. I think it was like 15 or 20 sliding glass doors. The hail was so big it created holes in the hardy plank. So we got a brand new hardy plank, brand new paint job, new roofs, new insulation. The insurance company ended up putting about $10,000 a door into our property for us. So that one, and it was built in the 80s. So that one, we're debating right now whether to refinance or keep it. But if we keep it, there's going to be very minimal CapEx for us to do for the next 5-7 years because it looks like a brand new property because of the hailstorm. So that's one piece to it. Not all of your deals have big hailstorms like that. So it really comes down to, is the systems, the long-term system, something that you want to deal with. So like one property we sold in Colorado Springs, it was all wood siding. It was flat roofs. It was individual HVAC. But other ones, if they have a chiller, that's something to look out for. That's a $80,000-$90,000 price tag if it's a replacement of those. The one in Colorado, it was on a hill, which wasn't the problem, that it was on a mountain, because the ground up there doesn't really move, but it had a lot of catwalks. So a lot of cement, a lot of steel supports that eventually someone's going to have to replace. And I didn't want to be that person. So someone made us an offer $30K higher a door than what we paid. So it was time to exit that deal. I mean, that just makes sense, right? And then something I just kind of thought about, the past 2 weeks I'm debating about, but I think I've got my answer, that the properties that are less than 100 units in our portfolio, we're probably going to start selling those off. Those units, then we have some small ones. I broke my own rule. I bought a 23 unit deal only 2-3 years ago, but it was the numbers just were amazing on the deal. So we bought it. Whatever. So that one, we've got a deal in Arlington that's 56 units. Those deals are a little bit harder to manage, but then there's also a lot of demand for those because there's a lot of new buyers that want to buy those assets. So we may sell that one as well.
Got it.
It just kind of depends on the physical attributes to the property, and where we've taken it. And if we could just get some ridiculous offer, then heck yeah, we're sellers. So.
Got it. Well, Kenny, you have been an awesome guest. Thanks for giving so much of value. You want to let the audience know how to reach out to you?
Yeah, James. So thanks for having me on. I appreciate it. Our website is wolfe-investments.com. So that's Wolfe with an E on the end of it. Social media, Kenny Wolfe. We're also on LinkedIn. We've got a YouTube channel. So you can find us all those various ways.
Got it. Thank you, audience. If you guys are seeing live in multifamily Facebook group, put in your questions. Kenny's in the group, and I can answer any questions as well. And if you are listening from the podcast format, just come and join us in multifamily Facebook group in Facebook, or subscribe to us in iTunes and give us a good rating. I think that's it. Thank you very much for joining us.
Thank you.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.